Hey everyone, my name is Ian. I invest for dividends. Dividend stocks make me incredibly happy, and I hope they make you happy as well. I bought a stock last week, as you can see on the screen right now. This is Raytheon Technologies. It's actually my ninth largest position in my portfolio. This stock comprises about 3.6% of my portfolio. I want to cover this stock in the video today because I believe it's presenting some value. My patrons already know about this because I share my stock trades over on Patreon. You can see that in the pinned comment below if you want to learn more. But I want to cover this stock in the video today because it's not talked about that much. This is a company that specializes in the defense sector, also in the consumer aerospace sector as well. And the stock has been trending down. It's down about 18% from its 52-week high. I believe the price earnings ratio is compelling, and so I've been purchasing more shares of Raytheon Technologies. As you can see on the screen in front of you right now, I want to start the video today with just a few metrics. You can see that I bought more Raytheon Technologies last week on September 8th. I purchased at $86.78 per share. As of today, it was at $87.82, so very similar range, but it's down 18% from its 52-week high of $106, and it's actually up 10% though from its 52-week low of $79. When I look at these metrics, I see some compelling value. Now, Yahoo Finance right now is not showing the forward analyst estimates for this particular company, but I have a post I did on Patreon back from one of my prior Raytheon Technologies trades from July 11th. And so if I pull the analyst estimates from then, they were estimating 478 this year, 580 next year, which puts the forward PE ratio at 18.15 this year and a 14.96 next year. So I saw that and it basically screamed value to me. But in the video today, actually, I want to go through this in a bit more detail. You're going to see why there's no free lunch in dividend stock investing. And yes, there could be some compelling long-term value here, but I'm also consciously taking on risk. And so that's something to keep in mind. But as you can see on the screen right now, what I did as well, in addition just to relying on the estimates that the analysts had back in July, on the right-hand side of the screen, you can see that I pulled the estimates for this year, for 2022, from their Q2 press release from the company. And they're estimating 460 at the low end of the range, a 480 at the high end of the range. You can see that the analyst estimate of 478, it's somewhere in this range. But anyway, the analysts are estimating a PE ratio in the 18s this year on a forward-looking basis. And so this kind of confirms what the analysts were thinking back in July. And so perhaps in 2023, we will see the PE ratio trend down as this company earns even more money. And when I see a world-class company like Raytheon Technologies, which is a core stock for me, trading at a PE ratio 2023 forward in maybe the 15, 16, 17, somewhere in that range, I'm compelled to add to my position. And that's what I did. That's why I added more shares last week. Now, worth noting, the dividend right now is 55 cents a quarter, which is $2.20 a year. Starting yield is kind of low at 2.54%, but the payout ratio is only 46%. There's room to increase the dividend, and that's what they've been doing. They've been increasing this dividend on average by 7.6% per year for the last 2 years. And I'm pulling the last 2 years because it's been a standalone entity only for the last 2 years. Before it was a bigger company that had some spin-offs, which I own. Otis Carrier, I own those spin-offs. Now, market capitalization is $127 billion. And so I want to go through this stock in the video today. I want to go through my analysis a bit. I'm doing the video a little bit differently today. Hey, the seasons are changing. This is the first time I'm wearing a sweatshirt in a while. Thank goodness. I'm so excited for the fall time weather. We're going to see all those leaves falling from the trees pretty soon, just as those dividend checks are being spun off by the giving trees that are these dividend stocks like Raytheon Technologies. And so I'm going to do stuff a little bit differently in the video today. No long introduction, none of that. Let's just jump right into it. So I was mentioning Yahoo Finance. Check it out on the screen in front of you right now. I want to cover this really quickly. Just this is a kind of basic data point for dividend stock investors. But I used to pull, as you can see on the screen, the earnings estimates from Yahoo Finance. But they're having the revenue estimates, but the earnings estimates, they're all zeroed out. And I'm seeing this right now, as you can see on the screen, for a lot of different companies. And so what did I personally do to pull my estimates? Well, one, I referred back to some of my past data. I love having my Patreon because it serves as a journal for me as well. And so one of the things I think is really important as a dividend stock investor is to keep a journal, whether it's digital, whether it's written. I have both that include some important metrics from the past because it's a great way for dividend investors to refer back when the data is not always easy to find online, or also just to cross-reference past data points. But what I did, as you can see on the screen in front of you, is I just pulled the Q2 earnings release. And the Q2 earnings release, as you can see, was really strong. And I'll go through this in a minute, but all the way at the bottom, you can see, hey, we're confirming an adjusted EPS of 460 to 480 this year. That's under the outlook for full year 2022. And so when I can't get the estimates from the analysts, where do I go? I go directly to the source. And so I want to go through that earnings release in the video today. But before I do that, everyone, I just want to share some announcements with all of you. Thank you for being a subscriber here on my channel. If you are not a subscriber already, I please encourage you to click that subscribe button. There is so many videos here and there's so many more on the way. Dividend stocks make me happy, and I want to share that with the world. But as you can see on the screen in front of you right now, let's just talk about a few channel-wide announcements right now. Announcement number one, I want to talk about the theme of today's video. There is rarely a free lunch out there with large cap dividend stocks, and so this is a somewhat efficient stock market. When there are opportunities, generally there are some risks involved, but as a long-term investor, I like to take on calculated risk, and when I take on calculated risk, it can oftentimes work out for me in the very long term. And so we see already Raytheon Technologies trading in a forward PE ratio maybe as low as 15 when we're looking forward to 2023, maybe even in the high 14s. Is there a free lunch here? Not necessarily, and I'm going to uncover their statement of cash flows, which shows why it's not necessarily a free lunch, but I am taking on calculated risk, but it's calculated risk I'm willing to take on with a core stock of mine. In terms of other announcements, I want to give a shout out. One of my absolute favorite dividend investing channels other than my own, perhaps the favorite channel other than my own, is Brandon Beavis. Brandon Beavis also has a private membership group for Canadian investors and for investors all around the world called the Investing Academy. Check out the pinned comment. I will link to Brandon Beavis, and I will link also to a video that he published. I have been blessed to collaborate with Brandon Beavis, and I have been doing some guest presentations live on his Investing Academy. Usually they're early in the morning on Fridays. One of my recent videos that I shared over there, or recent seminars that I presented over there, Brandon liked it so much that he decided, hey, I'm going to go ahead and I'm going to publish this here on YouTube for everyone to see. And so I will link in the pinned comment not only to his YouTube, but also to that video that he published. And in my video, I share a spreadsheet, which Brandon links to, that compares and contrasts dividend growth stocks that have low starting yields but high growth rates, and it compares that to high yield dividend stocks that have lower growth rates but higher starting yields. And it shares where the inflection point tends to be between the two, because all kinds of dividend investors have different goals in life. When do they want to retire? How much yield do they need right now? How many years are ahead? How much growth do they need to reach their goals? I love my spreadsheet because it's one that can be used to help model and understand in different scenarios out there what makes sense when making these decisions between the dividend growth stocks and the high yielders. And in my personal portfolio, I have both. And so check out that video. And also, as you can see on the screen in front of you right now, I have some more announcements. I want to just share, hey, I live in Idaho now, in the greater Boise area. Is there anyone out there in the greater Boise area who watches this channel? Please put in the comments below if you'd like me to organize a meetup at Starbucks. When I used to live in the Bay Area in California, I did all these dividend investing meetups at Starbucks. They were a lot of fun, and I'm thinking about organizing one here in Idaho. So please do, if I have Idahoans here on the channel who love dividends, who want to meet at Starbucks and talk about dividend stocks, I want to set that up, but I only want to do it if you're actually out there, so let me know. And my final piece of housekeeping today, as you can see on the screen, is I want all of you to be really careful out there. My channel is gaining in popularity. I am blessed. I'm so thankful for everyone who supports the channel. And with popularity, unfortunately, comes some imposters, unfortunately, out there on Instagram and on Twitter as well. I'm getting some imposters. They're reaching out to my subscribers. And the latest scam, I guess, that they're running is they're saying, hey, meet with Ian's financial advisor. I just want all of you to know that as of this time, I'm not a licensed financial advisor, and I'm not referring anyone to financial advisors at this time. And so if you see something like that, think twice, think critically, reach out to the community, reach out to me, just tread with caution, because unfortunately there are some imposters out there on the internet, and rather than add value to this world, they're just trying to go out there and trick people. And so the only things right now, there are two that I'm actively promoting are my Patreon, which is a paid subscription, monthly subscription for bonus content. And I also have a store that sells some really cool merch as well, like sweatshirts and t-shirts and stuff. And so with all of that, I want to get into Raytheon. Check it out on the screen right now. This is their Q2 earnings release. This is why at first glance, I thought this would be a screaming value when I saw the PE ratio on a forward basis trending so low, because you can see that sales are up 3%, 4% organic growth, adjusted EPS is way up. It's up 13% versus the prior year. They're achieving cost synergies. They're repurchasing shares. They're getting some strong free cash flow, and so on and so forth. And so when I see these top headlines and I see a PE ratio so low, I hear no one talking about it. I see the stock trending down. It's a core stock for me. It's one I want to own more of. I just go out and I buy some more shares. But I don't fool myself, because there is no free lunch in dividend stock investing, and I want to get into that. And so as you can see on the screen in front of you right now, I'm going to go through a few metrics that I like to look at. And so the first thing I want to share is just some balance sheet analysis. I'm not showing the actual balance sheet here. I'm just showing a balance sheet summary that I made in Excel. And when I look at this company on a strict balance sheet standpoint, it looks amazing, because the assets are 159 billion and the liabilities are 86 billion. You subtract assets minus liabilities, you get some amazing shareholders' equity or book value. But the fact of the matter is that they have 53.8 billion in goodwill, which is when they paid more for acquisitions than the book value of those acquisitions. And they have intangible assets of 37.5 billion. So in reality, is the goodwill an asset that they can realize? Maybe if we're in a really good market and they want to spin off some companies or sell some of those acquisitions, maybe they can reclaim that goodwill and get its full value. Are the intangibles really worth what they're claiming? I don't know. Just as a conservative analyst, sometimes I like to discount goodwill and intangibles and understand what their true assets are. And when I carry kind of goodwill, basically being worth only 10% of what they say it is, or I discount it by 90%. And when I say intangibles are worth only about 50% of what they're carrying it at, I basically get a goodwill discount of 48.4 billion, an intangible discount of 18.7 billion. I get true assets of about 91 billion. 0.8. And what that tells me, when I take the true assets and I subtract out the liabilities, I get true shareholders' equity of about 4.8 billion. Now, worth noting, is shareholders' equity worth more than that? Probably, but I'm looking more at a base case. I'm looking more at a corner case, the worst case. And I just want to share with investors that sometimes just looking at the metrics that the company provides at a top level, it may make things look a little better than they are. Certainly, I think Raytheon Technologies offers a balance sheet that looks a little more impressive probably than it is. Now, what I really want to share that is important, and I think why the stock is trending down in the short run, is because of the cash flow statement. I want to break this into 3 screenshots. The first one I want to share on the screen with all of you right now is the top level. You can see the cash flows here. It takes in the net income from operating activities, net income from continuing operations. And I'm going to look, at the 6 months ended June 30th. We'll look at it for 2022 versus 2021. So these are the columns all the way on the right. And you can see that certain items are added back, like depreciation and amortization, but certain items are subtracted out, like some deferred income tax, for example. And so this reconciles against their statement of earnings to understand really what's going on with cash flows behind the scenes. This is really important as a dividend investor, because dividends get paid out of true cash, not out of GAAP earnings per share. And so anyway, when you go all the way to the bottom here, net cash flows provided by operating activities, you can see it's actually lower than last year. It's gone down. So whereas I just told you, hey, revenues are up, organic revenues are up, hey, earnings per share adjusted basis are up, and they're up quite a bit. On an actual cash flows basis, it's down. And so I think a lot of investors, and myself included, we look at these big headlines on the earnings per share, on the earnings, and they look good, and I see value. And I still think there is value, but I would say that there is some risk behind the scenes. There's no free lunch, as I said, and the risk that I'm seeing behind the scenes is emerging on the cash flows. Let's keep going. As you can see in front of you right now, the second screen I want to share on cash flows is further down on investing activities. Let's look at this. On an investing activities standpoint, they've got a big line item for capital expenditures. And last year, they had some dispositions of businesses, which really helped them. So they had a positive net cash flows provided by the investing activities. But this year, they actually had a negative cash flows by investing activities. And you can see each year CapEx, capital expenditures, or investments they make in their business, investments they make in their manufacturing facilities, for example, they're actually a real expense. It's not covered in GAAP earnings per share, but it's there on cash flows. And you can see it's been pretty consistent. It's actually up, but it's a real line item each year. And so they're actually losing money there. Their money is outflowing from their cash flows because of those expenditures. Now, this is pretty normal for different businesses to have CapEx each year, but you're going to see the story unfold here and why there is some risk here. On a financing activities standpoint, they're losing money both years as well, or cash is outflowing both years. $3 billion last year, 3.6 this year. And again, mind you, this is only the first 6 months of the year. But what you see here is cash is outflowing from the company for the dividends that they're paying, and it's outflowing from the company for repurchases of common stock as well. Now, you're going to see something on the next screen which kind of sums it all up and tells you what's really going on here. And honestly, from a statement of cash flows perspective, it's not looking that good for the first 6 months of 2022. So as you can see on the screen in front of you right now, what I want to share is all the way at the bottom. Check it out. Cash and cash equivalents, end of period. If you look at the first 6 months of 2021 versus 2022, they are down. And so what this really shares is, hey, the company is making money on a GAAP earnings per share basis. Revenues are up, earnings per share is up, payout ratio looks good. But when you actually look at cash flows and you look at things like CapEx, share repurchases, dividends, they are digging into their pockets to pay this stuff out. CapEx, quite frankly, is a recurring line item. Dividends obviously are a recurring line item. Share repurchases don't have to be a recurring line item, but so many companies these days make them a recurring line item. If there's a red flag, if you will, and why is this stock down? Why is there quote unquote value? There's value because the cash flow statement doesn't look that good. And so the moral of the story today is there is no free lunch in dividend stock investing. Yes, I see value here, but what I'm going to be doing is keeping a pulse on cash flows. And with any dividend stock, the way I typically play it is I see ups and downs over the years. Typically when the stock is down, again, there's rarely a free lunch. It's calculated risk. But companies like Raytheon Technologies over very long periods of time, they're going to have periods of time when the cash flows don't look as good. They're going to have periods of time when cash flows look a lot better. This is one of the periods where it doesn't look as good. So I'm taking on calculated risk to add to my position. And so if you enjoyed the video today, please don't forget to go ahead and smash that like button. It does mean the world to me, helps out my channel so much. I look forward to seeing you in the comments below. Let me know in the comments below what you think about Raytheon Technologies and what you think about buying opportunities. Do you ever see buying opportunities where it's true value, or is there always some kind of calculated risk? For me, there's usually some calculated risk, but because I'm in Raytheon Technologies for decades upon decades upon decades, I will probably do just fine in the long term, as you can see by the stock chart in front of you on the screen right now. This is a stock, a company that has rewarded shareholders over long periods of time. Before I leave today, in terms of a full disclosure, I am long Raytheon Technologies, ticker RTX, Otis Elevator, ticker OTIS, and Carrier, ticker CARR. I own those stocks in my personal dividend stock portfolio. Also, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. All of my successes you will see, all of my mistakes you will see. I'm sharing it all here on YouTube for fun and entertainment. I love you all, and I will see you in the next dividend stock investing video.